The building has 87 apartments. 68 families are living inside right now. You are 23 years old, standing on the pavement, deciding if the numbers work well enough to buy it. The people inside do not exist in your spreadsheet. Real estate private equity runs on one brutal truth. Find a building people undervalued, buy it with borrowed money, fix what is broken, and sell it 5 years later to someone wanting a stable asset. The math is visible. The building is physical. You can walk through the front door and put your hand on the cold wall. That clarity is the whole point. But every level of this career extracts a different pound of flesh. If you are enjoying this ruthless reality check, a sub goes a long way. Level 1, the analyst. You spent 2 years at a bulge bracket bank. You wanted to own something instead of just advising on it. Real estate felt tangible. You are 23 years old. Your base salary is $115,000. Your first-year bonus will land between $40,000 and $60,000. Total compensation is approximately $160,000. After rent on a one-bedroom apartment in Midtown and taxes, the number feels considerably smaller. Your job has 2 functions. You build financial models in Excel and Argus for every acquisition the fund evaluates, and you make those models correct. The first function takes hours. The second function takes days. A standard Argus model for a 300-unit apartment complex has over 400 input cells. You have reviewed each one twice. The fund is evaluating a value-add multifamily deal in Houston. It has 87 units, built in 1981, and is 78% occupied. In-place rents are running 12% below market. The business plan is to renovate the interiors, push occupancy to 93%, and sell in 5 years at a 12% net internal rate of return. You build the waterfall. You run the exit cap rate sensitivity. You run it again 50 basis points wider. You run a third version with renovation costs 20% above budget. The deal goes to the investment committee. The investment committee deck is 42 slides. Your model is referenced on 14 of them. You do not attend the meeting. You sit at your desk and wait for a message from the vice president. It is approved subject to financing. You respond in 1 sentence. You go back to the model. The deal closes in 11 weeks. The press release carries the managing director's name. You are not mentioned. The vice president sends you a text saying, "Good work on this one." You read it at 10:45 on a Thursday in a cab you took because the subway felt too slow. You have 3 more Argus files open on your laptop due before Friday morning. There is a second deal coming, and it is significantly larger. The vice president pulls you into a conference room and asks how many models you can run concurrently without making errors. You say 3. She means 4. You find this out over the next 6 weeks when she assigns you 4. Level 2, the associate. You are 26. The MBA is not required at this fund because your banking background transferred directly. 2 of the associates beside you spent 2 years and $200,000 at Wharton between their bank and this desk. You saved the time and the tuition. You are not sure you saved anything else. Base salary is $140,000. Year-end bonus comes in at $135,000. Total compensation is $275,000. The number is real. The lifestyle is not proportional to it. Because 60% of your waking hours belong to this fund, your function has changed. You no longer run models that other people designed. You design the models. You set the assumptions: cap rate, rent growth, renovation timeline, exit multiple. When the deal thesis is wrong, it is your assumptions that were wrong. The vice president explains this to you in a post-mortem after your first deal underperforms. You revise the assumptions. You carry the lesson forward. You are working on the fund's largest deal to date, a $220 million acquisition of a mid-rise office building in Washington, D.C. The seller is a pension fund unwinding its office exposure. The business plan is an office to residential conversion, 44 floors, becoming 286 apartments. The city's conversion tax incentive reduces the effective land cost by 31%. The permitting risk is real. You model 3 scenarios. The downside case, where permitting runs 18 months longer than projected, barely clears the hurdle. You present the analysis to the vice president for the first time without being coached on what to say. She asks 4 questions. You answer 3 well. The 4th, about a specific clause in the tax incentive modified last year, you did not know. You find the answer in 40 minutes and send it by email before 6 o'clock. The deal is approved at the investment committee with a permitting timeline modification. Your downside scenario was the correct one. The managing director says so in the meeting. He does not say your name. He says the model showed it. The vice president conversation has started, not formally. A hallway comment, informational, D, non-binding. To make vice president at this fund, you need to originate. You have been executing for 3 years. Origination requires a different kind of skill. The question forming in the back of your head is whether you have it. The question does not stop arriving. Level 3, the vice president. You are 30. The title change came with a specific reassignment of risk. You are no longer accountable for the model's inputs. You are accountable for the model's conclusions. The associate builds the assumptions. You sign off on the thesis. When the thesis is wrong, your name is on it. Base salary is $175,000. Bonus this year was $190,000. Total cash compensation is $365,000. The fund has also granted you a nominal carry allocation in Fund 3. The fund closes in 4 years. You have been told the carry will be meaningful. You have run that scenario more times than you have run the exit analysis on any actual deal. Your job is the full acquisition. You manage due diligence, review legal documents, negotiate the purchase price adjustments, and produce the investment committee deck. The associate builds the model. The director sources the relationship. You operate everything in between. You lead the acquisition of a $480 million logistics portfolio. It includes 14 warehouse facilities across 3 states. The seller is a regional developer unwinding a joint venture. The deal has complexity. 3 facilities carry environmental indemnities from prior industrial use. 2 have anchor tenants on leases expiring in 18 months. 1 has a zoning discrepancy the title company flagged. You work through each issue with legal, the environmental consultant, and the associate assigned to the lease review. Due diligence runs 9 weeks. You are on the road for 3 of them. Charlotte, Columbus, Indianapolis. You walk every facility. You meet the property managers. You read the maintenance logs. The rent roll tells you the income. The maintenance log tells you what the income is concealing. The deal closes with a $312 million senior loan at 5.8% and a $40 million mezzanine tranche at 9%. You managed both financing processes simultaneously. You submitted $19,000 in travel expense reports during the due diligence period. You do not check your personal bank balance during active closings. Looking does not help, and the number tends to be the same regardless. The Washington, D.C. conversion is now 6 months behind on permitting. The base case is tracking to the downside case. The managing director knows. He is not concerned yet. You are concerned. Being ahead of the managing director's concern is your actual job. You understand this new brutal reality, and you adjust your life accordingly. Level 4. The director. You are 34. The title means one specific thing at this fund. You source. The vice president executes. The managing director closes. You are the bridge between the pipeline and the product. Your job is to know which buildings will trade before they are formally listed. You must have the relationship with the seller before the deal is live and bring the opportunity to the fund's attention 3 months before every competitor receives the offering memorandum. Base salary is $250,000. Total cash compensation this year was $540,000. The carry allocation in Funds 3 and 4 has grown. On paper, the figures are significant. If Fund 4 performs to plan, your carry over the next 3 years will be several $million. If Fund 4 underperforms, it will be substantially less. You have modeled both scenarios more times than you would like to admit. You have spent 8 months cultivating a relationship with the family office that owns a 4,800-unit apartment portfolio across the Sunbelt. 14 properties in 3 states. The patriarch's estate is in probate. The heirs want liquidity. They have not engaged a broker. If you move before they do, you can structure a direct negotiation, avoid the auction, and acquire the portfolio at a capitalization rate that reflects the off-market discount. The portfolio trades at $950 million. Your name is on the sourcing memo. The managing director presents to the investment committee. The partnership flies to Dallas for the property tour. You run the 3-day site visit, the lender meetings, and the legal kickoff call. Your name is not in the press release. At this fund, sourcing credit lives in the internal attribution model, not in the announcement. The deal closes. It is the largest transaction in this fund's history. You take the weekend off. It is the first full weekend in 9 months where you do not open your laptop on Saturday afternoon. On Sunday evening, you open your laptop anyway. There are 46 unread emails. 3 are from the associate on the next deal. The building is coming to market in 6 weeks. You have started thinking about what the job looks like, one level up. The managing director spends 40% of his time on limited partner relations. Pension funds, sovereign wealth funds, endowments. You have met some of them in passing at the annual investor meeting. The managing director is not the fund's deal man. He is the fund's face to the people who control the capital. That is a different skill than sourcing a building. You are not certain you have it. The managing director is watching to find out. Level 5. The managing director. You are 38. The real title is capital allocator. You decide which deals the fund pursues and which it passes on. Everything downstream flows through the vice president and the associate. The models, the due diligence, the legal reviews, the site visits. You are the investment committee vote, the limited partner call, and the handshake in a boardroom that commits to a deal 3 months before the associate opens a new Excel file. Total cash compensation last year was $810,000. The carry in funds 3 and 4, if both perform to plan, will generate between $4 and $6 million in realized distributions over the next 3 years. If they underperform, it will be considerably less. The carry is always the number you are actually working toward. The salary is what you live on between distributions. You are managing a $14 billion deal pipeline under active review. 3 deals are in due diligence simultaneously. One is a $1.7 billion logistics platform acquisition spanning Germany and the Netherlands. The seller is a German pension, reducing its alternatives exposure. The transaction requires legal opinions in 2 jurisdictions, a Luxembourg feeder structure for non-United States capital, and a debt package spanning 3 lenders in 2 currencies. You are on calls at 6 in the morning for Frankfurt counterparts and at 11 at night for the Singapore Sovereign Fund co-investing on the debt tranche. You attend the annual limited partner meeting. There are 43 limited partners in the room. Pension funds from Ohio, Ontario, and Oslo, 2 sovereign wealth funds, and 3 university endowments. You present fund performance for 22 minutes. 18 of those minutes are straightforward. 4. Address the Washington, D.C. conversion. It is now 32 months behind on permitting and $14 million over the original renovation budget. You present the revised projections without flinching. Several limited partners ask follow-up questions. You answer each one. Nobody pulls their commitment. 2 schedule separate calls for the following week. One of your vice presidents approaches you after a deal closes. She has been at the fund for 6 years and wants a real timeline to direct her. You give her a real answer. 2 more originations and meaningful improvement in limited partner-facing communication. She writes it down. You recognize the gesture. You did the same thing at 31, sitting across from the managing director who then occupied your chair. You have stopped running models. You realize this one morning when the associate asks a question about a capitalization rate sensitivity. You have to reorient yourself to the cell reference before answering. The answer is correct. The path to it takes 6 seconds longer than it used to. Level 6, the partner. You are 44. There are 9 partners at this firm. Together, you manage $11.2 billion across 3 active funds and 714 assets in 14 countries. The investment committee meets every other Tuesday. You have a vote on every single dollar deployed. Total compensation in a good year is $3.2 million. The year before was $1.9 million because Fund 3 had a sluggish exit environment and 3 assets were marked down. The variation does not affect your lifestyle. Your lifestyle calcified somewhere around year 12 and stopped updating. The variation affects your carry account. That is the number you actually track. Fund 5 is in the market. The target raise is $4 billion. You are responsible for the lead relationships with 7 of the fund's anchor limited partners: 2 sovereign wealth funds, 3 pension funds, a university endowment, and a family office with $12 billion in investable assets. Your job for the next 6 months is to ensure all 7 commit before the hard cap. One of the 7 is the Ohio pension. Ohio lost a board member last year who was a champion of the fund's strategy. His replacement has questions about the Washington, D.C. conversion. You have a call with her next Tuesday. You have been preparing for it for 2 weeks. Fund 5 closes at $3.8 billion. One limited partner you expected to commit cited allocation constraints at their own board level rather than performance concerns. You send a personal email the evening of the final close. 14 sentences. You wrote and rewrote it 3 times. In this industry, how you lose a relationship matters as much as the relationship itself. Your son is 12. He asks what you do at work. You tell him you buy buildings, make them better, and sell them. He asks if you own the buildings. Technically, no. The fund owns the buildings. The limited partners own the fund. You manage the fund and own a fraction of the profits above a specified return threshold. You tell him you help decide which buildings to buy. He nods and asks if you can get him courtside tickets to the Knicks. You can. You do. You sit in the investment committee meeting and watch a vice president present a deal you have not yet reviewed. She is 32 and has been at the fund for 7 years. The relationship she built to bring this deal in took 14 months. You vote yes. You do not say that the exit assumption is 14 basis points too tight. You ask about it instead as a question, giving her the space to defend it. She defends it well. The deal is approved. Here is what the waterfall does not show you until it is too late to change it. Fund 3 has been running for 9 years. The portfolio is unwinding. The carry calculation is being run in real numbers for the first time rather than projections. Total distributable profit above the preferred return is $340 million. $68 million in carried interest is to be allocated among the fund's investment professionals. The carry allocation table was set at Fund 3's inception. It reflects the titles and contribution levels of the team at that precise moment. 41 people have worked on Fund 3 deals across its 9-year life. 11 are still at the firm. 30 are not. The associate who built every one of Fund 3's 47 acquisition models left in year 5 for a competing fund. Her effective economic interest in the $68 million is approximately $80,000. The vice president who led 8 of the fund's 12 largest deals left in year 6 for a family office. His carry, negotiated at departure, produced $320,000. The director who sourced the 4,800-unit Sunbelt portfolio, the single largest value creation event in the fund's history, was let go in a restructuring in year 7. His unvested carry forfeited entirely on the date of termination. The legal language is standard. A non-compete triggers forfeiture of all unvested profit participation interests. 51 of the $68 million in Fund 3 carry goes to 6 people. 4 were partners at the fund's inception. 2 were promoted to partner during the fund's life and held their allocations intact through the full cycle. The waterfall is working exactly as designed. Everything that happened is entirely legal, standard, and normal in this industry. The question the waterfall cannot answer is simpler than any model you have ever built. The people who created the value and the people who captured it are not the same group. You have known this since year 4. You did not leave. You are still here in this chair, watching a 32-year-old defend an exit assumption that is 14 basis points too tight. You let her defend it. You vote yes. The deal is approved. The carry clock on Fund 5 starts today. The ultimate lesson of this industry is that physical bricks matter far less than the ink on the partnership agreement. The people who grind through late nights create the foundation of wealth, but the architecture of the fund dictates that only the architects themselves capture the ultimate prize. Looking ahead, the next market cycle will look exactly like the last one. There will always be a new generation of analysts willing to trade their youth for the illusion of proximity to power. New funds will rise, new restructurings will erase unvested equity, and the waterfall will continue to flow exclusively upward. The fundamental game never changes, only the players cycling through the seats. So I have to ask you a serious question. Are you the one building the financial model, or are you the one quietly owning the waterfall? Where do you currently sit in this relentless hierarchy of capital? Drop down into the comments below and share your own experiences from the trenches. If you want to keep peeling back the curtain on how these markets actually operate, make sure you subscribe, turn on the notification bell, and share this video with someone who really needs to hear it.